Alrighty. Welcome to Forex.Today, the YouTube community of over 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's go! And guten Morgen. Yeah, good to see you. My name is Wayne. Nice to meet you. I'm a foreign exchange trader just like you. I love trading. I love investing. Oh my God, look at Swiss franc. You looking at the Swiss franc? I see it right there. Swiss franc is weak. Hey, about 5 days ago, was it Thursday of last week or Wednesday? I'm like, be on the lookout for Swiss franc intervention. Aussie getting crushed. Dollar a little bit strong. Yen kind of strong. But the news to use is the Swissy is a dog with fleas. So anyways, we'll cover all of that. I love trading. I love investing. I like building portfolios. I love stocks. I like bonds. I like commodities. I like options. I like it all. I'm a capitalist pig dog. This is what it looks like. I love money. The money is the root of all good. Because it's leverage. It leverages your goodness. You can do good things with money. Yeah. And by the way, it was never said money is the root of all evil. No. The love for money, or not the love for money, the whatever. It's the, if money is that goal, if, I don't know, whatever. Look it up. Money's not evil. That's all I'm saying. We don't need to go into that. All right. So this one I'm talking about, Swissy taking a nosedive. Do you know it? Did you know? You got to know. So maybe the first thing you should do is look for opportunities. You've missed that? You missed it. What do you mean you missed it? Yeah. Some good ops here. What else going on? Euro Swissy. This is the one I told you to watch. Or I told you to use this one to analyze, how you say in English, potential intervention. Getting distracted by charts here. The charts are all weird. That's what it was. I don't know why it was that way. A little better, I guess. Cool. So anyways, we are on a key pivot point if we go further out. Okay. Now, going back to, it would have been the morning, I guess, of the 20th. We identified this range at that time. So it would have been the 19th. Okay. We analyzed the range. We analyzed the price action. Okay. We say somewhere in here is the expected up. Cool. The expected, okay, target is based on the pullback. Me. All right. So you do this analysis that I just circled here. You do this at that point. And at that point, you say somewhere around this point, this point, and this point. That's why it's a whole zone. You want to go up. That's all you know. You don't even know if it's going to pull back. Okay? But after the pullback, this pullback is projected to go to 1382. 1382.2. And that is precisely this number here. Oh! Yeah. Now, if this is central bank intervention, which we talked about a week ago, yeah, then that's really not that meaningful. But it is what it is. Also, when you look at the 4-hour, really, you bought a dip off the 21? Oh my God, that's amazing. That's amazing. That's amazing. Yeah. You know what else is cool? Let me try to get rid of this old trade. Okay, which worked great, didn't it? Oh my God, but things have changed seasonally. There we go. Let's get rid of this and get rid of that. Okay, here's what we know. If you are a bear, the projected low for March is down in here. All right? That's in the training course at investorbootcamp.com. The second thing is if you hit that early in the month. And by the way, you feel free to call out bullshit if you think I'm making this up. But that's the target. And if you hit that target early, then it's expected to go all the way back to the central pivot point. Maybe beyond, we don't know. So I only teach one counter trend trade. And that's it. You just learned it. There you go. Compliments of the firm. I love you. You're my sweet baby. Hang on, my chat is delayed. I'm going to try to update it. Let me test the chat. Good morning. chat is right here. All right, cool. So, anyways, that's the one counter trend trade. Very cool. But what is most important here is not that, because that's technical. A week ago, I said, keep your eyes peeled, your ear to the ground, and be ready for Swiss bank intervention, in particular, them weakening the currency, and in particular, weakening their currency by buying euro. That's pretty specific. And that's kind of smells like what's going on here. Okay. So again, not backfilling. This is what we discussed. And that's kind of cool, right? So now you can also just pick anything you want, pretty much. CAD doing well on oil, don't you stink? Now this would collapse if if suddenly our exogenous supply shock goes away. But that smells like a double bottom. Then you can go to daily and look at that beautiful little move. Look how beautiful this is. I hope you see the value of double bottom. Well, actually, I mean, if you wanted, you can call it a triple bottom, but let's not overdo it. Double bottom, higher high, higher low off of, okay, not just the moving averages, but the roll reversal. So, therefore, indicators, bias pivots, bullish. Okay, Jose. And check this out. Okay. So that is your buy zone. The other thing you can do is, just like I did on the other, you can say anywhere in here. You don't know which one, but which one, if it works, tells you the target. But the other thing going on, and I know there's a lot of stuff going on now. Okay. We have this whole area is maybe a buy zone. Maybe this area here is a buy zone. Anyway, here is a buy zone. So you can see they overlap. Opportunity 1, opportunity 2, opportunity 3, double bottom, higher high, higher low. And this is important because it tells you where to put your entries. So you could, for example, let's say you typically trade a standard lot or a mini lot. Okay, a mini lot. You can do a third of a mini lot here, a third of a mini lot here, a third of a mini lot here, and a stop of one mini lot here. So you pick up some, you pick up a little more, you pick up most, then you stop buying, stop buying, stop buying, stop buying, stop buying, stop buying, you're out. Or you get all the opportunities and then you slowly build your position. So if it comes down, you take your, at least you're in. And then you catch the next one, and then you're in, and then you catch the next one, you're in. Yeah. Can somebody type in the chat? It's not working for me. I I see that you're participating in the poll, which I appreciate. So I mentioned the projection is built off of where it actually finds support. So I'll delete all that. I do want to kick off the moving average. I do want to kick off the next buy zone. So this does catch my, or pique my interest. And so far, it looks like it's piqued the interest of several others. But it also might just be the beginning of something beautiful, in which something beautiful out of something bad. We don't get peace in the Middle East. We continue our exogenous supply shock. Oil stays high. Two things happen. Canadian dollar gets strong, but Swissy gets strong. Switzerland doesn't want strong. They want weak. So what you end up doing is this intervention actually continues, okay, until resolution. Now, technically on the daily chart, that puts us here, which is actually the same target that's being projected by this math. This is what that math projects. But if this is bullish, then throughout this period, guess what? This section will move higher as this moves higher. And what will happen is it'll overlap here, which is perfect, because this black line here is suggesting that's our target. So that's the tactical strategy. Hey, Greg and Greg. Yeah, I can do S&P for sure. So that's what this says now. But if that starts to be true, and let's say the next few days we have green candles, then this will go up mathematically. That makes sense. And then this will go up, and they'll be about the same, if not precisely the same. Same math, really. Both are implied volatility. Yeah. Think about it. That's what Fibonacci is, implied volatility. Based on what happened on this period, it's implied pullback and up. That's called a trend. Well, it's implied you're going to get a pullback. Cool. What does this mean? Well, you might be a scalper, which is perfectly fine by me. But this could be something that you scalp only up, and for weeks, not hours. Weeks, my friend. Oh, Lord. Weeks. Okay. So, Wayne, teach me how to do that. Oh, okay. That's it. You'd be here all day. This gray box gets drawn automatically. I'm talking about the one here. I have that pre-programmed to say, it's time to come to work, time to get to work. Doesn't really tell me anything else. You should already know if you're a bull or a bear. There's a lot of things out there like says, well, if it breaks out here, it breaks out there. Dude, you don't know what to do? That's your problem. Don't use some stupid indicator to tell you bull or a bear. That makes no sense. This is geopolitics, macroeconomics, and monetary policy. That's what's happening on this 1 minute chart. So you should be able to thread the needle and say WTI is high, benefits CAD, Swiss bank intervention going on. Why did you? They told you. Did you watch the meeting last week? Did you read the reports? They gave you intervention on a silver platter. Remember, central banks need you to do the trades, and they're very aware of this. Remember, Mario Draghi reversed the entire global capital flow based on the Greek debt crisis and default by simply saying he would do anything to protect or to do whatever it takes to protect the euro. Words. And the flow of money to Europe was extraordinary based on words. Well, the Swiss National Bank last week told you with words, wink, wink, nudge, nudge, you know what I mean? Intervention, you know what I mean? Nudge, nudge, intervention. Yeah, weak Swissy. Probably weak euro. But then why is the Swissy so strong? Oh, geopolitics. Oh, well, what's the impact of geopolitics? High oil prices. Well, who benefits? Canada. Who gets crushed? Japan. So CAD yen, CAD Swissy should just be tip of the spear for you. Right, Greg and Greg? Mr. Anderson. All right, so now you're in skippity scalpy mode, is all I'm saying. But you base it on logic first. And then you drop into this 1 minute. Now I don't care. Now, the other thing that does matter to me is where we are on the 4 hour. So that's why I started there. Now, I didn't start with this view, but what does this mean? Double bottom, roll reversal. Perfect roll reversal, by the way. Check this out. Look at that, dude. Dude! Look, I'm looking at that little red line right there. Little red line. Okay? All right. So there is logic, there is intelligence going on. Okay? And you see it right then and there. This tells me that there are buyers, there are orders in the market. But I don't trade the 4 hour. I do strategy on the 4 hour. So when's a good time to trade? Oh, well, I have that pre-programmed. That's the 5 minute chart of this. And that's my pre-programmed where I say, Wayne, it's time to get out of bed and do what needs to get done. Now, to be fair, I'm usually up 3 hours before this. But, oh my God, it's pretty good. Yeah. Little red Corvette. Yeah. It's kind of cool, isn't it? Grid? Yeah. I'm not a big fan of gridding, but I get it. When it works, huh? Yeah. So if you were going to grid this, you would say, yeah, you'd go back. Let's see if I can even fit that in there. I think if I Having a brain fart. I think. Uh, uh, it's the setting. Is it that? Yeah. All right. So I want to be able to see, right, that double bottom is critical. And I have to see it on a proper time frame. It's too far out, right? Okay. So I guess I have to go all the way to the daily. I have to understand that we've achieved the bottom and then we've made a continuation higher high. Then the role reversal. So it's essentially a 1, 2, 3. Now I need to like mark the top of the range there as well. Okay. Let me do it this way. Because that's where the orders are, right? That's where the support's going to be. Why? Well, if you know how to trade, that's where they're going to be, right? Oh yeah, Greg. What I'm getting to, Greg, is that I don't disagree. I just do it differently. I don't think you and I have ever disagreed. Strategy is strategy, right? Tactics. Hey, look, some people kick the door down with their right foot, some people kick the door down with their left foot. Door dismantled either way, right? All right. So what I'm saying is we get to this and then we drop into the smaller time frame and we know the importance of this price level. So in this morning section, you could do a fib. I know you can't see it because it's black on black, but we'll highlight this zone. That, okay, and then I'll remove the fib. Okay, this is the buy zone using Fibonacci. This gray zone is just a time. It's a timing. It says calculate the range from the open, from the first few minutes of the open, like the first hour of trading. First hour of trading, notice again it's automatic. Soon as it came out, it stopped going up. It fell for that whole hour down into our Fibonacci retracement. This has nothing to do with being bullish or bearish per se, because we did our bullish bearishness before even getting to this chart. We did it on the daily chart. So now there's the zone pullback off the support in the daily 1, 2, 3. This is where you go, you could, I'm not saying this is the way, but we're talking about Greg using a grid. Okay, you could, for example, this is a type of grid, if you will, where you just set it, say, well, I'm a bull and I expect a pullback, and my stops are going to be below that support. Meaning buy, without you doing, right? Okay. See, I don't care how you enter the trade. What I care about is the bigger part that you understand the context of why you're entering the trade there. And you can say, well, it's one standard deviation below the mean with a positive slope. Yeah. You can say, oh, it's a role reversal. Yeah. You could say it's a 1, 2, 3. Yep. You can call it a hammock. Yep. You can call it the daily 21. Yep. 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 It doesn't matter as long as you got that. And then the rest is like, well, how do you get into it? Well, that can be done all kinds of ways. Right. Right. You can do that. Now, some people, what they'll do is they'll set a buy order here and a sell order there. I don't really like that. Or I suppose you could do reverse, sell it here and buy it there. Or you could sell it here, buy it there, buy it here, sell it there. And then you can set all this up. And now you got yourself almost like an option strategy. Yeah, but dude, why not just make a decision? Hey, oil's going up because, or cat's going up because oil prices are high and you expect them to stay high. Hey, the Swiss National Bank is intervening in the value of the Swiss franc, so I guess I'm just going to buy this at after respective support, after a higher high, then I'll buy a higher low. Dude, that's the point. That's right. That's what we love. That's what I love. I think that's what you love. Not that, you know, like, oh well, we'll put a buy limit here, we'll put a limit there, and then no, 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 no. Stay away from the tricks, guys. Stay away from the tricks. This is not a dog and pony show. You're going to need to make decisions. A new login process. Boom. Easy peasy. Launch the analytics platform.
Good morning. Let us get you up to speed on the current macroeconomic landscape. We are witnessing a clear transition into a risk-off environment catalyzed by a sharp rise in the U.S. 10-year yield to 4.406%. This upward move in yields is coinciding with a spike in the VIX, leading to broad-based selling in global indices and a significant strengthening of the U.S. dollar against major currency pairs. Biggest movers right now, high yield bonds and silver are down. US oil, volatility index, and Hang Seng are up.
Cool, right? Yeah. So as Aidan said, high yield bonds and silver are down. Oil, vol are up. So VIX is up. Oh my God, 27.5. Well, that's part of our risk off. S&P 500 down. Emil, just do what I just did and you'll be fine, Emil. Go to the home page, click on the button in the top right. Okay? But feel free to email me. I'll double and triple check everything. For most people, because there has been changes to the site and your browser stores old versions to make the browsing experience faster, if you got the old version stored, you should refresh your screen. Let's get an update on the headlines. Australian dollar, US dollar tumbles as safe haven demand rises amid Middle East tensions. U.S. Richmond Fed Composite Index 0 versus 10 expected. United States Richmond Fed Manufacturing Index came in at 0, above expectations 5 in March.
U.S. S&P Manufacturing PMI rises to 52.4. Services PMI declines to 51.1.
Pound yen slips as weak UK PMI data weighs on sterling. South Korea balanced bouquet outlook under Shin DBS. Markets nervous amidst renewed Iran tensions. U.S. March S&P Global Flash Services PMI 51.1 versus 51.5 expected. 9 hours away from meeting minutes out of the Bank of Japan from their last meeting. Yeah. Which was a doozy, huh? What else do we got going? After that, we'll have Australian CPI. Lots of RBA data, and then CPI out of the UK. Oh, refresh your browser. If it still doesn't work, send me an email, and I'll research it for you. Yeah, I have a permanent fix now. All right, so one of the things that we looked at is VIX is up, right? So what do you do when VIX is up? So VIX is up right now 6%. Holy crap. So what does this mean for us right now? See, that when you have access to TRADARS, you know what to do immediately. If this happens, that's likely to happen based on quantitative analysis, not rules of thumb, wives' tales, assumptions, all that's gone. Quantitative facts. So we track every asset. I think it's 57, Heinz 57. We check 57 assets. That might actually be wrong. It might be 75. But anyways, we track at least 57 different assets on multiple time frames, capture all their price action of every single one of these, and then correlate them to each other using the Pearson correlation coefficient mathematics explained here, and update it every 30 days so we don't have legacy data of like what happened 5 years ago. No. Over the last 30 days, how does every other asset move compared to every other asset based on market conditions? And then track it not just directionally, but magnitudinally to say right now VIX is up 6.6, dollar index Dixie has a correlation of 0.42, moderately positive. Right now, we expect the dollar to gain 2.61% today. Now, based on that, based on the 30-day facts, done. What about the S&P 500? It's going to be brutal. Oh my God. With a jump of 6% on VIX, dog with fleas day. Or you could just guess. I don't know. You can just guess. And we have this for everything, for everything. Oh. And you're like, oh, oh, oh. Yeah. So if dollar is strong, okay, so VIX says dollar should be strong. You're like, well, I don't trade VIX. Okay, great. If dollar's strong, okay, USD yen up. Pound dollar down. Euro dollar down. Isn't this cool? Holy snickersnocker. Think about it. Think about it. Think about it. Shh, 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 shh. You log in and, oh my God, VIX is through the roof. What do I trade? Dollar. Okay? Of dollar, what do I trade? Boom, 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 boom. Direction and magnitude. Done. Do this, don't do that. Oh my God. That's pretty sweet, isn't it? That's pretty sweet. And you can do this throughout the day as market conditions change. You can change it and just find out what you should be looking at. Yeah. Oh. Okay. Swissy was strong 2 hours ago. Was it 2 hours ago? I think it was about 2 hours ago. 3 hours ago. 3 hours ago. No, 2 hours. 2 hours ago, Swissy was strong. And now we have this intervention move. And it seems like Swissy has strengthened compared to where it was. So Aussie Swissy was much more down. Okay. Swissy yen was I don't remember where it was. So these seem to be on the move. There's that CAD Swissy. There's that USD Swissy. This is Euro Swissy. Pound Swissy is what we were looking at. But what I'm trying to get at is when we looked at this earlier today, when you look at the top contrarian opportunities, okay, one of the best opportunities offered was Aussie Swiss franc buy a dip. Aussie Swissy. Yeah. And for some reason, Euro Swissy's not even here. That might have scored higher. I'll look into that. Kind of like how he's drawing this heat map here. It makes me think like instead of a scatter plot, we could do it this way where you break it into quadrants and you can show most correlated and most well, most contrarian. Oops. Most contrarian and most trarian. Anyways. Well, that's because of the rise that we saw in the yield curve, right? Right here. Right, Greg? That 4.4, like, yeah, gold is coming down. Now, longer term, we're still bullish, but yeah, that's why it's happening. Yeah. And money has come out of gold. Okay, the market is still long 38.9%. About. It might be 38.92%. But market is net long gold, but have sold some of the positions. AB growth dividend fund. What is AB? And then also, that's, yeah, no, for sure, Greg. But what I'm saying is we're watching the sale of gold, right, by institutional investors. Now, what a lot of people are doing is they're not net short gold. They're selling to take profit to pay for losses somewhere else. Now, normally I would have thought gold would have had flows into it week over week, but as a hedge. But that hedge was already in play. So now the shit hits the fan and assets were crushed. And that's when you take the money off the hedge that already made you money to, and now you go to cash to, and then you have, so whatever. It's sort of like the hedge worked. And what I want to see is when I want to hope and pray for gold to go up, I have to confirm or deny the hope has any validity with actual track of flow. And there's no flow. The flow is out. Okay, going back to Mr. Wright, I don't know what your AB growth dividend fund is. So what is AB? The second thing is, what does 13.7% dividends tell you? The dividends are based on implied volatility. So you're going to accept in return for high yield massive volatility. Yeah. So a classic scenario is you can lose 35% of your net asset value and then be paid 14% dividend. Doesn't matter, you still lost a boatload of money. The second thing you need to do is read the prospectus and stop asking YouTubers, because YouTubers are generally not qualified to answer these questions, right? So I would tell you to read the prospectus. And very often, high yielding funds or ETFs achieve this high dividend, like I said, through you assuming massive levels of volatility, which you don't want, by the way. Or the second thing they do is a legal form of cheating and lying. It's a legal form of a Ponzi scheme. Now, those are bold words, but I know what I'm doing. So, and I'm bold. So what the hell? I'm not that old. I'm bold, but I'm not that old. All right. There's return on capital, and this has to be disclosed in the prospectus. But we know amateur traders don't read the prospectus, so it doesn't matter. So they can cheat you all you want. Nope. They know none of their clients are going to read it. So as long as it's legal, they're going to cheat you. So read the prospectus and look for things like return on capital, which is like return on investment. For every dollar they make, how much profit do they make? And then distribute back to you as a dividend. That would be how you want it to work. Right? They made money on investing and they distribute some or all of that profit back to you in the form of a dividend. Cool. Actually, I just fixed it, H2 producer. It is fixed. There's a couple of people that have legacy issues from the initial launch, but it's not based on, so I just have to kind of rehab it. So the buggy is fixed. I worked all weekend. I slept 4 hours in the last 2 days. It's fixed. Yeah. Anyways, the second thing, and this is where the Ponzi scheme comes in, is very often these high yield investment opportunities provide the high yield from something called return of capital, not return on capital. That's your money making profit. No. Some of the dividend they give to you is some of your money. It's not actual profit. They're not paying you a dividend from profits. They promote themselves to amateur retail investors that are looking for high dividends. They're like, give me a high dividend. Oh my God, this one pays 14%. Cool. But some or most or all of that money is your money. So what they do is then sell the ETF or mutual fund to another amateur retail and then pay you with their money, and then you pay them, and it's they can actually lose money in investing, and then you're like, hey man, where's my 60 cents a share dividend? Oh, here's your 60 cents. But what they did is they took it out of the fund, not out of profits. Oh my God. So you're like, boom, I got my 14%. Meanwhile, they're losing money. And you don't care because you're collecting a 14% dividend and you don't track their performance. You don't even know what they invest in, and you don't read the prospectus. Yeah. All right. Well, read the prospectus, Mr. Wright. Find out what they invest in. What is the volatility? Is it a return on capital? Is it a return of capital? What do they put the money in? Oh, they put the money in, African emerging markets, or with, look, how do you earn 13% safely? You don't. That, right? So, for example, you want to earn money safely? All right, well, you can put money into the 10-year T-note, pays you 4%. No. Well, look. Mr. Wright. You say so far you invested in the USA with 8% dividend, but 13 feels a bit too much. No, that doesn't make any sense. Your feelings, I don't care about. A bit too much? What the hell does that mean? Oh, it pays me too much. That doesn't make sense either. Your feelings don't make sense. Too much doesn't make sense. It's relative to what you're putting your money into. So I'll give you an example. Let's do okay, check this out. You can invest into an Argentine government bond that will pay you somewhere between 29 and 32%. How does that make you feel? Well, Mr. Wright, in the United States, mutual funds are dead. People invest into ETFs. But check this out, everybody. Okay, now we're having a real intelligent conversation about investing. Should you invest into a 13.7% dividend mutual fund? Well, why would you do that when you can invest into an Argentine government bond that pays you 30? Return on investment is no, that still doesn't make sense. It's relative. How do you earn the money? So this is risk-free or nearly risk-free. I don't think Argentina's government will default on you, although it's possible. What's the real problem with this? Yes, default. Okay. There you go. 47% inflation, and they only pay you 30% a year. Mr. Wright, 30% isn't enough to even break even. Don't freak out about the 13.7%, although it's a red flag. But you can earn 13.7% in NASDAQ. But you can also lose 13%. Okay? So now it's relative to a benchmark, which we call like beta or correlation. So we have the correlation coefficients. But, you know, I'm telling you to read the prospectus and understand what you're investing in. So 30% Argentine government bond is guaranteed to lose you money. 30% is not enough. 13% might not be enough. 13% might be too much. 13% might be accurate. But that's why we can go to like if the stock market is falling, okay, what do we know? VIX is high, VIX is high, VIX is high. Okay. So right now, S&P 500 and NASDAQ fall the most when VIX is rising. Okay? So, in market conditions, where do you want to be invested? Do you want to own the stock market? Yes, I want to own the stock market. Which one? All of them. I want to own everything. Okay, there's your investment strategy. The second thing is, how do you manage your portfolio to reduce risk? When we are in bad market conditions and volatility is high, you're better off owning more Dow than NASDAQ and the S&P 500. Because it's less volatile. It falls less. But fall, it will. But then when you hit recovery, meaning you enter seasonality or technical charts or a change in market conditions in which you think the stock market's going to go up for the next 2 or 3 months or 2 or 3 years, you need to rotate out of Dow and into NASDAQ or S&P 500. And by the way, this is just over the last 30 days, so they're all highly correlated. So their beta is about the same because everybody's getting hurt by geopolitical risk. It's systemic risk. It's not macroeconomics. So when macroeconomics return to normality with reduced systemic risk around geopolitics, then this data will change. And if it goes to volatility falls, so we're at 25, 26, it should be 15 or 12, then you'll say, based on quantitative, and I'm going to assume here, you want to be in NASDAQ, but you want to be in NASDAQ in the transition, not after the fact it's already happened, but because VIX has collapsed. Let's say VIX is down 5. Aha! Rotate out of safety, low beta, and rotate it into higher beta because you bought a low and you want the higher beta because you're expecting a higher high. Well, the one with the most beta is going to have the highest high. But on the way down, you want the highest low. So here you're going to get your highest low and then rotate over to catch the highest high. Well, great. Pretty much the same thing because you leave the money in your account. What do they do with your money in your account? They buy treasuries. So either way, if you're earning 4%, it's just because you didn't buy the 10-year T-note. They did, and they're going to collect a fee. Either way, it's what's happening, right? But if you take your money out of the account and put it into the S&P 500, now what you've done is taken the money out of the account, so they sell the treasuries, go to cash, take your cash, use it to leverage, and now you own shares of the S&P 500. And so you've shorted treasuries and you bought stocks, and that would be normal. And that's right. And that's the whole point of, right, the expected return of a stock is equal to the risk-free rate of return plus the beta of the expected return of the market minus the risk-free rate of return. So what you're doing here is opportunity cost. Your risk-free rate of return, oops, finish. There we go. The risk-free rate of return is just this. If you're moving money from treasuries into the market, you have to say, well, the market is paying you 10, but you gave up 4. So your real return is 6. That's what this math is trying to do. Now you're 6% times the beta of the asset. What asset? This asset. the expected return of a stock, or in this case, stock indices. So now you would want to look at, say, well, what asset are you buying and what is its beta relative to the benchmark? Is it a higher beta or is it a lower beta? And then this is part of that calculation, right? Yeah. So the calculation of opportunity cost. So if you decide, okay, we'll get rid of all this. And now we're going back to our investment discussion. If you decide to keep your money in cash in your Fidelity account, Fidelity just buys the risk-free rate of return. I mean, you could buy the Treasury and collect 4.25%, but they're buying the Treasury on your behalf and paying you 4%, and they're keeping 1/4 for themselves, or even 1/2 for themselves. But you're happy because you got it in cash, it's safe, and you're earning an interest. Cool. But you're not in the market anymore, so you've sold the market and bought Treasuries. And then when you think the timing is right, you sell your Treasuries and you buy the market, the S&P 500, let's say, and that's why you see things like the stock market up, yields down. What, right? No, sorry. Stock market up, okay? Bond prices down, Treasury prices down, so you could do yields up. Because, right? Now, these guys have to compete more because of the money going here. Anyways, what I'm trying to ultimately say is read the prospectus. 13.7%. Is it a good investment? I don't know. That doesn't mean anything to me. This is why we have Sharpe ratios and Sortino ratios. Okay? So when I did the algorithmic trading program at Oxford, one of the things we did a lot of is analyzing different forms of alternative hedge funds and high frequency trading funds. And so you have fund A, but we'll use this as an example, not my Oxford stuff. Fund B and Fund C. Let me go a different direction I was originally going to go. Fund C. Okay? This is a classic undergrad question that you would receive in finance. Okay? Maybe a little more intermediate or advanced finance, in particular investment, right? Right? An investment class, but 13%, should I invest? Mr. Wright says. Fund B is 7%. And Fund C is, let's keep it about the same, right? 30. There's a ratio here, but just to kind of, not on purpose, but kind of on purpose. But the thing is, which one should you invest in? This is classic undergrad finance. This is what finance is. Tracking the flow of capital. And in this case, you'd have to say, well, what are you investing in? Okay. For Bitcoin, Forex, and real estate. Okay, which one is best? You see what I'm saying, Mr. Wright? Oh, I've already done that, Mr. Wright. I've already done that. I have a 16-hour class on doing stuff like this. Yeah. Okay, how do you decide which one is best? Now you say Fund B. Why? I don't. How did you decide? The question isn't which one is best. I said which one. How do you decide? There's two answers I'm looking for. They come from different points of view, but they're both a way to make that decision. How do you make the decision? How would I make the decision of your 13.7% fund? Well, I have to do the analysis. Greg says take A. You're not telling me how you make the decision. A might be the answer. A might be the worst of the three. How do you know? They're not even the same. Yeah, but okay, but how do you know? So you're going to say, well, I think Bitcoin's highly volatile. I don't care what you think. It's what you can prove. Tell me the mathematical study that you're going to use to tell me in order which one is the best and which one is the worst. This is basic investment strategy that everybody needs to know. And by the way, when I looked at 10,000 opportunities to invest using a copy trader type firm, I found of the 10,000, there were no investable traders. None of them even passed the basic test. Now, many were profitable. I don't give a damn about that. I have money, so I'm more concerned about risk. If you don't have any money, you'll risk it all because you have nothing to lose. All right, nobody's answering, so let me get to the, right? Let me share two things. Internal rate of return. For every dollar invested, how much does it yield? But even better, and something else you're probably familiar with, Sharpe ratio. And this is also very good for measuring three different things. So, like for example, I studied real estate quite a bit at Harvard. I took commercial real estate, and general real estate, and all that kind of stuff. If you're going to decide on different projects, should you buy this building or that building? Should you renovate this building or should you make a new one? Of the three, one is $1 billion, one is $100 million. Which one makes most sense? So you would do internal rates of return and all that kind of stuff to figure out dollar for dollar. And then from that, then you can then say, well, then which offers the best absolute return? And okay. In investing in financial markets, in particular traders, whether it's a hedge fund or a Forex trader, a retail Forex trader, an ETF, a mutual fund. Okay. How do you make a decision when this does Forex, this does real estate, and this does Bitcoin? And then you could do another one. One does stocks only, and one does global stocks only, no US. Some might do global X China, Japan. And you're like, there's thousands of opportunities. How do you decide how do you compare thousands of different opportunities that are kind of related, not related, correlated, uncorrelated? how do you make the decision? The Sharpe ratio, because it looks at the volatility. So we'll call that risk. How much risk are these guys taking relative to the performance, the return? How much risk? How much return? How much risk? How much return? And not over a month, because you can say, well, I got a Sharpe of 3 for over 4 weeks. Yeah, well, dude, okay. How about over 4 years? Okay. And what you should look for is, what is the volatility and how much return did the Forex fund earn relative to the volatility? Because what will happen is they made 13% but took 30% volatility, which means at the end of any given year, you wouldn't know if you'd be down 13% or up 13%. So in reality, your real return relative to risk is 0%. You didn't make any money. Well, this year you made money, but don't worry about it. Next year, there's a high probability you're going to give all that money back. So what's the frickin' point? 13% is not enough. That's a bad investment. Okay? Then you look at this one and, well, it's a, it's an illiquid asset. So you're not going to mark the market, and it's not going to liquidate very quickly. So you're probably just going to sit on this long term, and you'll earn your 7% a year. And so it'd be very low volatility and very consistent return. So maybe that is true. Maybe it's not true. And I'm not making a statement about real estate. This could be anything. This could be a real estate ETF. But if the Sharpe ratio, okay, is good, then it's a maybe. And by good is like between 1 and 1.5. If it's 2 or 3 or 4, I'll tell you what Oxford did teach me. On the very first day of the algorithmic trading program, and I did it from a fund manager point of view, not from the trader point of view, fund manager point of view. And the very first lecture of this class that teaches me how to analyze investment opportunities quantitatively, the very first lesson was, if the Sharpe ratio is too good to be true, it is too good to be true. It is bullshit. Go find out why. So, if it's between 1 and 1.5, that is spectacular. If it's 3, bullshit. And they're lying somewhere, and you have to go figure it out. You don't just say, that's too high and leave, like, it's too much money. No, go figure it out. Now, you do Sharpe ratio on Fund C, and once again, it pays a lot, but relative to the risk, you could be up 30%. And what if you could be up 30%, but down 60%? So you have to take 60% risk to maybe get 30. This one, you have to take 13% risk to maybe get 13% risk. Maybe this is easier to understand. But what if you took 2% risk to get 7% return? So almost every year, sometimes you're up 5, sometimes you're up 7, sometimes you're up 5, sometimes you're up 7, but you're never down like negative 30. You're never down negative 60. So using something like Sharpe ratio, you're able to analyze per unit of risk how much return you are getting. So this could have a negative Sharpe of negative, I see things like this, negative 6.3, but right now they're profitable. The thing is, you just don't know if in a month they're still going to be profitable. You could be up 10% this month and down 15% next month because it's volatile. So yes, you're profitable now, but it'll have a negative Sharpe ratio. Yeah. This might, in this situation, your Sharpe ratio is probably negative 0.5. You're like, okay, it's not bad. I'm just not really getting paid. You're leaving some money on the table. I mean, up 1 year, down the next, up 1 year, down the next. It's not really that great. I mean, you're not losing any money, but nobody wants to tread water, especially with inflation. So then you look at a Sharpe ratio, right? So like my Sharpe ratio is just above 1, which means I do not leave even a penny of reward on the table. But I also don't take a unit of risk too much. Straight down the fairway, and I'm not trying to hit 300 yards. That's the point. My goal is to hit the center of the fairway. Because if you're driving for 320 yards on every hole, sometimes you're going to be high in the right and you'll find yourself in the pine trees, in the pine straw, where the sun don't ever shine, shiver in the whole night through. So look, I don't want to hit it into the forest. But I do want a good golf score. So my goal is hit fairways and hit greens in regulation. And never get myself into trouble. I don't know if that's a good analogy. So look, by the way, if you look at the top, I think top 100, but let's say you're top 50. No, we'll do top 100. I bet you if you're in the top 100 professional PGA or live golfers, top 100, you're a millionaire. Now, you have to fly first class on Delta. You don't have your own private jet, but maybe you get a sponsorship, whatever. Right? You fly first class on Delta. And your job is golfing in the most luxurious locations around the world. And you spend the vast majority of your time in 5-star hotels or outside in beautiful conditions. That's your job. You never win a golf tournament, but you always place decently, because you never take risk, and you make millions of dollars, and you never win? Yeah, but you never risk losing. Yeah, and that's kind of where you want to be in here, in particular if you're already a millionaire, and you're right, or you're talking to millionaires trying to convince them to invest into your trading or investment vehicle. Like, let's say you start a fund or something, where you're going to do managed accounts and that kind of stuff. This has nothing to do with the 7%. This has nothing to do with the asset class of being real estate or a real estate ETF. I made all this up. It's all about the Sharpe ratio. You can also do a Sortino ratio and all that kind of stuff, but if you don't understand Sharpe, you don't understand investing. So you can get all this information in the prospectus and stuff, but the bottom line is you want to understand risk and performance, reward, risk and reward. So is 13.7% a good investment on a mutual fund? I don't know. You haven't told me the risk. What are you investing in? Bitcoin. What's a sharp on it? -4. No, heck no. Heck no. Are you nuts? I would never invest into that. But it pays 13.7. Yeah, well, you're probably going to lose money. That's what Sharpe ratio tells me. So I can walk into a room with institutional investors that manage money, and they can ask me, Wayne, what's your Sharpe? And I say, just over 1. They're like, cool, that's it. I can sit down with a potential investor, show them my portfolio performance, and if they're astute, they don't even look at how much money it makes. The first thing they look at is Sharpe. And they're like, oh, you got a Sharpe just over 1? Cool. Now they'll look at other stuff. They'll look at other stuff now. Well, when was your biggest drawdown? What was occurring there? Oh, well, on Liberation Day, we had a 3% drawdown. Actually, the month of Liberation. So when was that? April of last year? Yeah. So April of last year, my performance was -3. Now, is that bad? Again, it's relative. So what they'll do, what a due diligence team will do, is then look at what all their other assets did on Liberation Day. And do you remember the markets being down -20? They're like, oh shit, Wayne, you were down -3, and this was down -20, and that was down -17, and that was down -10. You were down -3, dude. You're a baller. And I'm like, yeah. And then we made, 3% in the next month and 2% the next month after that. And like, we're golden. And now that's how you invest, ladies and gentlemen. It's always relative. So now they can say, what's your Sharpe? Just over 1. Good. Let's continue the conversation. Don't tell me about your worst month. Don't tell me about your best month. Tell me about your worst month. Boom. Then they look at that. Negative number could be very positive. This is why I say in my book that I wrote 20 years ago, take pride in your losses. One of the best things I've ever done in the last couple of years is lose 3% on April of last year because of Liberation Day. It's something to celebrate. So anyways, there's my long answer. Was that too much? Did I get too far off track, or did anybody enjoy that? We should have a new sit rep report. Yep.
Good morning. Let's get you up to speed on the current economic landscape. The market has transitioned into a decisive risk-off environment following a sharp 5.4 basis point rise in the U.S. 10-year yield. This upward yield trajectory is strengthening the U.S. dollar while forcing a retreat from equity indices and commodity currencies like the Australian dollar. Biggest movers right now, Bitcoin, Ethereum, and high-yield bonds are down. U.S. oil and Hang Seng are up.
You're right, Richard. So this is, Richard says, yeah, the more money you have, the more you need to hedge. Well, yes. I'm only hesitating on the word hedge. There's there's another approach. It's a form of a hedge. I mean, yes, but the reason we have seasonality under fundamentals, so we have a fundamentals tab, we have seasonality, is to know and anticipate when the stock market's going to fall. I hope you know that there are people in this room with us right now that have planned for the stock market to fall in January, February, and March. It was planned. It was assumed because we have the seasonal data. So, how do you hedge? Right, Richard? As I mentioned, one of the things you can do is decide what to be long. Should you be long Dow? Should you be long S&P 500? Should you be long NASDAQ? And that's where you get into things like the beta or the correlation. And so if the stock market is down, so let's try to do this in pieces. If NASDAQ is down, VIX is up. So we're reverse engineering this. Well, no, Sharpe ratios for investing, not trading. Great. Investing. But if you're going to raise money, you're a trader, you might not care about Sharpe ratio, but the investor does. So your trading should produce a good Sharpe ratio. If not, then you might be profitable as a trader, but what you don't know is you're over leveraged, you're taking too much risk, whatever the form of the vol is. So you might be profitable, you're just not as profitable as you should be. So for example, you might have a lot of volatility with scalping, and you're profitable as a scalper, but because you never let your winners run, your vol is high and your return is low, but you're like, well, I made $1 million last year. And like, yeah, well, if you just bought and held, you would have made $10 million last year. But you don't know because you took 10 pips a trade instead of 300 pips a trade kind of thing. Your entries were fantastic, but none of them were big winners. And so all you have is small winners and volatility. So, that's the thing, right? So let's reverse engineer. You look at seasonality and you say, and seasonality tells you January, February, March. And I'm just making this up. You can use a seasonality tool whenever you want. But let's say you do your analysis and you believe in the next 90 days, NASDAQ's going to be more likely down than up. Okay. Down, they're negatively correlated, so volatility will be high. So then you can go to the vol now, and if you believe in the first quarter, the odds are the stock market retraces. Now, you don't know if it's 5%, 10%, or 30%. That's not what seasonality really tells you. I mean, it kind of, but you don't, there's always a black swan and all that kind of stuff, but 10% is normal. But anyways, you will be hurt the least by being in Dow based on this information. And then let's say you look at seasonality, April, May, June, volatility falls. that means the stock market would rise. What should you be in? Not Dow, but NASDAQ and S&P 500. Now, this is actually a little oversensitive for that amount of information because they're all behaving roughly the same, because this is systemic risk and not macroeconomics. So they're all being hurt about the same. Normally you'd see Dow a lot less and NASDAQ a lot more, but this is the sign of the times. But in the seasonality, I do break it down, the 5-year average, the 10-year average, the 20-year average, and then the exponential moving average of the averages. So it does actually show you the proper, we'll call it correlation, meaning it will tell you the likelihood of when these are going to fall and who's going to fall the most. NASDAQ. So get into the one that falls the least. So you rotate and reallocate and rebalance your portfolio. We're talking about a hedge, Richard. You say, well, I'm going to move money out of S&P. I'm going to move even more money out of NASDAQ. I'm going to hide out in the Dow for a few months because the probabilities of this falling are greater. Then, once that cycle is completed, you're like, well, I think we're going to move into a risk-on mode for the next 3 months. So then I'll rotate out of Dow, which is less risky because it's all the companies are monopolies. They're going to make money if the markets are bad. Oh, we have a war? Yeah, well, Microsoft's still going to make money. Okay? But then when that seasonality changes to risk on, now you want less safety and more risk. And then you rotate out of Dow and some into S&P and even more into NASDAQ, depending on how you want to balance your risk-reward ratio. Remember, high vol is bad, but not if it pays you money. So if you're going to have a high vol strategy like scalping, you have to let the winners run. So enter your trades like a scalp, but then jam your stop at break even and let them run. If you're risking 10 pips to make 10 pips, it's just, well, you're not going to have a good Sharpe ratio. You're just not. Yeah, because it won't give you a good number that says this trader is going to be reliable. So last month, this month, next month, the end of the year, and then, you can have a reasonable projection on what your returns will be. But if you don't know if you'll be up 10% at the end of the year or down 30%, if it's completely random, then there's no way to plan, and it's not a safe investment. And if it's not a safe investment, then it needs to compensate you for the risk. And at that level of risk, you might need 300% to get to a Sharpe ratio of 1. 300% a year, or you go bankrupt at the end of the year. Well, you need to be informed, and that's what the Sharpe ratio will do. Euro-US dollar pairs losses as US dollar eases after PMI data. Why the Korean won is falling while the Kospi holds up.
XRP struggles to find direction as retail and institutional demand wavers. Pound.US dollar. Pound consolidates in tight band. Scotiabank. Washington initiated outreach with Iran, but noting reached the level of negotiations. CNN. U.S. stocks. giving back ground as crude oil prices rebound. U.S. dollar. Petrodollar foundations tested by Iran conflict. Deutsche Bank.
Tech falters while energy surges. Today's market analysis. Yeah. Alrighty then. Don't forget, in 8 hours and 38 minutes, we got the meeting minutes from the BOJ. Yeah, well, Greg, that's a good place to start. Now, there's a lot of people that'll poo-poo on a Sharpe ratio because there's many different variations. What I'm saying is, with institutional investors, it's always the very first thing you look at. Now, you may not pay much weight to it, but you pay a lot of attention to it. Meaning, you look at an investment opportunity, and the investment opportunity has a Sharpe ratio of negative 1.3. Okay, decision's over. Or decisions made. No, pass. Oh, but they're profitable. I don't care. Doesn't matter to me. You start there and you're nowhere near one. You're a negative one. Pass. Just pass. It's over. Meeting is over. Now, if you have a Sharpe of 1 or slightly above 1, you get to the next step. That's all it is, right? So let's say I was raising a fund and I was talking to a potential investor. I'd be impressed if the investor said, okay, so what is it you do? So you give him a little elevator pitch. Then he's like, all right, what's your Sharpe? Oh, 1.3. Yeah, let's do it. Let's have a meeting. Because at that point, he already knows, or she already knows that it's possible. It's a potentially good investment. So the next thing is, how does this investment fit in their portfolio? And what is it you do to have a good Sharpe ratio? And even more importantly, when your Sharpe ratio wasn't so good, meaning like in periods of drawdowns, how did you perform? Now, if somebody did that with my fund, right? So I manage endowments. If somebody said that to me, okay, they look at my Sharpe and it's good. So what's the next question? Okay, let's look at the worst performing parts of this portfolio. Like when did the portfolio fail? And then figure out why. Okay, that's where you go month by month by month. But there's a variation to the Sharpe ratio called the Sortino ratio, and Sortino and Sharpe work together. Sortino said, don't count the good vol, count the bad vol. So if someone was going to invest in my fund, and by the way, I manage, I advise charitable endowments. I'm not raising a fund. I'm not pitching to you. I don't want money from you. All right. If they look at my Sharpe, it's good. They're like, oh, this is a good fund. Second thing, how did it perform when the market was in a downturn, like now? Or how did it perform on Liberation Day? How did it perform when the S&P 500, the NASDAQ, the Dow were down, or VIX was up, or, bad fall? Who cares about when everybody's making money? That's easy. Don't count that fall. Count the drawdowns. Only look at the drawdowns relative to the benchmark. So like relative to the S&P 500, relative to that's usually the benchmark, right? Greg says, I like your Sharpe ratio. Great. So when things are bad, how do you perform relative to the S&P 500, which is a nice balanced benchmark? And if you look at my results, my Sortino ratio that looks at all the drawdowns in the market and then looks at how I perform, I actually do better relative to the S&P 500. So now an investor goes, oh God, that's great. Yeah. So going back to Mr. Wright, is 13.7 good enough? Well, I'm not doing 13.7, but I'm doing pretty close to that. And I bet you my trading is way better than that investment opportunity of yours. But I don't know because I don't know what's in it. I don't know the risk you're taking. I know that mine is incredibly low risk. I outperform when the markets are bad. I do great when the markets are good. We're compounding like crazy. The greatest problem with my trading is it produces far too much cash, which is a taxable event. So therefore, I do this for charities that don't pay taxes. Genius, 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 right? So anyways, I'm not here to tell you I'm better. I'm just saying if you looked at the prospectus and gathered the numbers and looked at things like the Sharp and the Sortino, those would be starting points to measure apples to apples. Is that fund better than mine? Is that fund better than owning the S&P 500? Is that fund the same as investing into Argentine government bonds? Do the math. I suspect I'd win. Not because I'm arrogant, because I know my numbers. I know them. I know these things. Yeah. Anyway, I hope you enjoy the conversations. I enjoy my time with you. I like what we do. I like you. This is a good group. Hey, Jim, if you're here, I got your email. I'm on it, man. I'll get this fixed absolutely today. Absolutely today. Love you, man. Yeah, it's amazing how down Aussie is lately, huh? It was so ridiculously up, and now look at it down. Oh, I forgot about that bug. I can fix that. Yeah, I got a 2.7 on gold. They're, things are performing fairly well. Like if you move to the contrarian. Silver rebounded. Remember how bad silver was the last few days, but silver was, in particular, last week. If I remember right, Thursday and Friday of last week, silver was a terrible performer, and in our contrarian, um, it had it as one of the biggest opportunities. Now we see silver up. Yeah, well, where were you then? Okay. XPT. What is that? Platinum, right? Platinum. Sell the rip. Platinum is up today, but we have a negative score in platinum. Isn't this nice to be able to read this? So instead of looking at the scatter plot, trying to figure out what to do, you could just jump to this, and it's like the best opportunity presented to you right here, right now, based on what's happening in the market right now, today, this hour. Sell the rip, potentially on platinum. Buy a dip on Aussie yen, Aussie dollar. Aussie Swiss is neutral, but it was one of the best opportunities at 8 o'clock this morning. And now it's neutral because it's already gone up. You're welcome, by the way. You're welcome. So you might like gold. Okay, you might like gold. Nothing wrong with gold. But there's, let's say, probably better opportunities at the moment. Ethereum might be a buy a dipper. Yeah. But see, the conviction score is pretty low. That's why it's low here. So it's combining conviction scores with percentage change. So gold right now, we are bullish on. It just hasn't done really much of anything. Nice to be bullish on oil and to see it up, because that's what we expected. Meanwhile, we could have just sat here this whole time just staring at that. Blah. Cool. So I'm glad we had an opportunity to talk about the potential for intervention. And I'm glad we talked about it last week, and I think we could be having intervention. So I think the Swiss National Bank said uh, they don't think the the war in the Middle East is going to end, and that's going to bring Swissy strength. So therefore, sell Swissy buy euro. Yeah. Or traders just saw this central pivot. It's kind of nice to know these things. Okay. So again, we hit the projected bottom of March, early in March. The next thing is you should expect the counter trend to return back to the central. We farted around here for a week or two, and now we kick off the moving averages, and we're on our way back to potentially a full Monty. In particular, with Swiss National Bank intervention, that actually gets us back up to here. Holy schnicker-schnocker, Batman. Dude. Loving it? Cool. You guys are getting quiet again. Have I gone too long? Too long? 2 hours is too long? Okay, we have yesterday we hit the monthly projected low for platinum. We also hit our weekly projected low for platinum. Does that impact how you feel? What is TRADARS telling you? TRADARS is telling you that the down part makes sense, and we've had that for a while. The beginning of March is here. If you know how to trade, then on March 1st, you said, if that's resistance, this is support. I hope you know that. I'm just taking that for granted that you know that. That's what that says. Okay. So now we just hit that. Now what? You should expect it to pull back. That's why it's there. Now, what TRADARS is saying is much of its assumption for the direction has to do with fundamentals. Some of it's technical, some of it's fundamental. We currently have a negative score on this asset, which says don't be shocked if you see this. And this is why the contrarian radar, under the scatter plot, there's the analysis that says that's actually the greatest opportunity available. Let me go back to this. Here it is. Sell the rip. See it all quantitative? XPT. XPT. Sell the rip. Conviction down. Price up. Opportunity compared to all the other opportunities 6.1. Ow. Did we hit? So you're like, well, Wayne, the last time you showed me pivot points, we hit the target early in the week. Yeah. And it went to the central pivot point. Yeah. So where's the central pivot point? Oh, good question. It's right there. So here's your trade plan. Oh my God, that's beautiful. Okay, now drop into a 1-minute chart. Okay, and now you wait to get bearish. Or a 5-minute chart. Is that bearish? No. Is that bearish? No. Is that bearish? No. The other thing that you should do is go to indicators, biased pivots. You're a bear, so remind yourself, bearish pivot. Cool. Look, what does that tell you? You're in a sell zone. Is it bearish though? I don't know. Is this going to double top? Huh? Is it going to double top? When will you decide? When will you know? Is it today or tomorrow? Let's go out to a 15-minute. There you go. Is it going to, right? Well, we can have a monster day today, or we could have a monster day tomorrow. But our assumption is somewhere between where we are and here, it's going to turn bearish. Now, that's based on this touch. There's more to life than that. We're also interested in this zone, which has already been calculated. Do we really want to see much higher than that? No. Why? Because you're probably also, because that's a role reversal, but you're probably also doing Fibonacci. And in my opinion, if you're looking at a 786 or higher, it ain't going to work. So now this is what I'm doing the rest of the day if I'm trading platinum. Based on what I'm looking at, I'm only interested in selling. Looking at prices, I think we're kind of in a decent area where it might turn bearish. And if it does, I could consider taking the shot. It might go higher, so I'm not that aggressive. And if it goes higher, in fact, I get even more conservative. But right here, right now, is it bearish on a 15-minute chart? No. So am I going to sell it? No. But, and yes, that's a big but, I cannot lie. I can sit here now and wait for this to turn bearish. On a 15? On a 5? If it does, I can take a shot, drop a stop, and let this drop the rest of the week into maybe next week. Maybe in a couple hours, I can move my stop to break even and not even face that risk. Why would I move it to break even? Reduce my volatility. So if I take a loss, guess what? My Sharpe ratio is improved. Aha! You see, Greg? So if my trading shows -3 plus 300, -3 plus 300, -3 plus 300, -3 plus 300. Half the time I win, half the time I lose. I have a great Sharpe ratio. Okay? Even if there's a -30 every so often, that increases the vol. But as long as my winners are higher than my losers, it's like as long as GDP is higher than inflation. So if GDP is higher than CPI, your economy doesn't have a problem. In fact, the problem of your economy is everybody's rich. But because everybody's rich, there's no need for money. Because productivity is so high, cost per unit is down. So people used to spend $250 on a TV. Now they spend $1,000 on a TV. But the TVs are unbelievable. Yeah. Yeah, you used to be able to buy a car for 30 grand. Now these cars cost you 60, 70, 80, 90. A basic BMW X5 is $103,000. But it's nice for a cheap ass BMW. Yeah, now GDP of 1.4 and inflation of 2.4. Uh-oh. Okay. That's not good, but then you have to then analyze, is 2.4 high inflation? No. So your economy is treading water. You want some inflation and you need productivity. So moderate productivity, right? Moderate growth and with a slight expansion of money supply, and in particular with velocity, yeah, it's fine. That's fine. I wouldn't freak out by a 1.4, 2.4. What you don't want is 1.4, 5.4. So, anyways, let me wrap up with this. I've taken too much of your time. It's been over 2 hours. I'm suggesting if you decided to be a bear. Now, I don't really care about platinum. It's just I'm teaching you how to use the fundamentals, the technicals, all this analytics that we have, and then be a trader. If you thought it was logical before you even opened this chart to sell this, then you're sitting here waiting to sell. Now, this is the price. If it goes higher, you probably walk because it'll take, not likely to go all the way to the central pivot point today. So if it doesn't turn south now or soon, forget about it because we're also running out of time. London's about to close. So you could just sit here ready to sell. Is it bearish now? No. That's all we know. And that's all that matters. And now you could have a very boring day just sitting here waiting to sell. Is it bearish now? No. Is it bearish now? No. Is it bearish now? No. In fact, you can see this template will tell you continuation and continuation. So it said, look, it made a lower low here. Uh-oh, well, things change. Dude, it's a 5-minute chart. What do you expect? And then continuation here. Maybe you want a different time frame. Yeah. But imagine now this decides to hold. And it does turn bearish. Then you can be short a while. That's all I'm suggesting. Not right? That's it. Trading and investing most of the time should be boring. Because you're waiting for setups. Okay? But that's why we have this lovely community. So thank you for being a subscriber. I appreciate you. Thank you for the patience and professionalism you have shown me. If you've had an email login issue because of the new system, I'm going to work on it right now. And that will be taken care of. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful trading day.